Okay, good afternoon, ladies and gentlemen, distinguished guests, and my esteemed colleagues. It is my pleasure to welcome you today to today's panel discussion on strategies to reduce fossil fuel financing. My name is Mark Kalega, and I'm an energy finance analyst at IEEFA, and I'll be the moderator for this discussion. I first became engaged with the divestment movement through participation in the BCTF Divest campaign, which is situated in British Columbia, Canada. In this campaign, a group of teachers concerned about the long-term effects of fossil fuel extraction on their environment are advocating for the withdrawal of their pension investments from all fossil fuel producers and infrastructure. Earlier this year, we produced a report proposing a straightforward, low-risk, and cost-efficient approach that BCI, who is the fund manager for the BC Teachers Pension Plan, can adopt in order to decarbonize their investment holdings and investment portfolio. Today, we have a distinguished list of speakers, each with their own unique background and perspective, to help shed light on developments and strategies to drive sustainable investment practices and restrict funding of the fossil fuel industry. I introduce my colleague, Christina Ong. She's a research and stakeholder engagement leader at IEEFA, focused on debt markets in the Asia-Pacific region. We also have Richard Brooks, who's the climate finance director at Stand Earth. Richard heads a team working to reform the financial sector with a focus on banks and pension funds. We also have Jackie Fielder, who's the co-director of Stop the Money Pipelines. She previously worked with Mazaska Talks and organized Divest the Globe 2017, which is a major international day of action targeting banks funding fossil fuels. And lastly, Lucy Pinson, who is the founder and executive director of Reclaim Finance. Lucy's work over the years involves convincing some of the largest French insurers, banks, and investors to adopt policies to restrict support for several fossil fuel subsectors. So we're just gonna go right into it, and I'll hand this over to Christina, who's gonna lead us with a presentation. Then I have some questions for Richard, Jackie, and Lucy, and then we'll open up the floor for questions from the audience.
Good afternoon. Mark Twain once said, "The secret of making progress is to get started." In the last few years, we've seen a growing trend of financial institutions doing just that, getting started on their decarbonization journey, and in particular, pledging to exit coal financing. And while there is a lot of narrative out there around, the pace is too slow, and we too at IEEFA recognize that, we also think that the hardest part of this journey is taking that first step. And so I'm going to talk you through, in the next few minutes, about our research that was published in May. And you'll find from this presentation that we are encouraged to see that not only is the new coal exit pledges growing, but so is the commitment to improving the pledges. The number of globally significant financial institutions that have made a clear commitment towards exiting their exposure to coal or ending new coal financing has been growing. The green bar on the left was the number of firms that made the commitment over a 6-year period from 2013. The green bar on the right is where we are at today. 200 and counting financial institutions with coal exit policies. You will note that the bar on the right has doubled the size on the bar on the left. So what we're talking about is twice as many financial institutions have announced commitments in a much shorter period of time. And you will also note from the chart that there has been a steady incline of new coal policies from 2019 to 2021, and then it slowed in 2022. Now, I can't avoid talking about this, but the hard data on that isn't easy to find. So we have some hypotheses on why it declined in 2022. One theory, to be blunt, is the politics in the US in particular. I think that has scared off a lot of institutions that were planning on making announcements. But outside of the US, we are also aware that institutions in Europe and Asia were obliged or required to wait to make those announcements until there is more stability in energy supply in their market. And lastly, I would be remiss not to mention that there could have been more institutions that announced a coal exit policy, but were not captured under our research because the scope of our research was banks and insurers with assets exceeding $10 billion US dollars and asset managers and owners managing more than $50 billion US dollars. So there could be a lot more numbers that were not captured. But despite the dip last year, we need to remember that there's still an upward momentum. And here, we're talking purely about the number of new coal exit policies. This next slide shows what financial institutions are doing after they established coal exit policies. Our research has found that not only is the number of new policies growing, a significant number of them have also improved the robustness of the policies. So even if we're not satisfied with the number of new pledgers, those that have made the commitment are now making enhancements to that position. And that growth in the last 2 years is exponential. And this could imply that some institutions have seen benefits in taking that position. I'll now walk you through some examples of how institutions have improved their policies. But first, a few caveats. You'll only be seeing a snippet of their divestment policy because these policy documents go pages and pages. The purpose is to show the diversity in divestment strategies that financial institutions have taken, and that not every divestment will look the same. The first example here is Caisse des Dépôts, a public sector financial institution and the investment arm of the French state. They started in 2016 with 3 commitments as part of their divestment policy. The first is to exclude equity and bond investments of companies that earn revenue from coal mining and coal power plants above a certain threshold. The second is to exclude equity and bond investments and lending in French projects with coal expansion plans. And the third was to engage with its investees. In 2018, they enhanced one of those commitments and replaced it with a more stringent threshold. And in 2021, they enhanced that commitment even further and added a fourth commitment, which is to exclude financing, all forms of financing, including guarantees, export credit, and refinancing of existing facilities related to coal. It also strengthened its engagement with investees in 2021 to require the remaining investees and borrowers to adopt a coal phase-out plan by 2030 for OECD countries and 2040 for the rest of the world, in order for them to qualify for capital. The nuance that I'd like to highlight here is that divestment policies are not necessarily a dump and run policy. In this case, the institution is prepared to work with the remaining investees through a net zero pathway. Now, I'm sure that the panel might have conversations around this later, so I'll keep this really brief, but the position taken in this example is that the institution is better placed holding relationships with certain companies only and helping them down a path. Much like what the great country singer Dolly Parton once said, the way I see it, if you want the rainbow, you gotta put up with the rain. But I digress, so I'll move on. So the next one is Desjardins, a large Canadian banking group. In my opening statement, I said that the hardest part of divestment is getting started. And in this example, the institution didn't know where to begin in 2017. And all they did was come out with a statement that says, we are going to exit coal. They did not have the roadmap for how they would do that. However, what we saw in 2020 is one of the most robust coal divestment policies globally. They now include financing and investments in coal projects and coal-related companies. They also ended the facilitation of deals, loans, and insurance. So in this example, the divestment strategy is interesting because it went from almost 0 to 100 in over 3 years. We're now going to pivot to Asia, and what you'll find here is how quickly this region can move. And I recognize that this example may not be reflective of banks or asset managers, but it's a particular example that can show how nimble the execution can be. So AIA Hong Kong is a big insurer globally, and insurers have a slightly different outcome to achieve. One of those outcomes is protection of long-term value to line up with their liability profile. In 2020, they saw a worldwide contraction in the value of coal companies. Now, you should note that AIA had a significant coal exposure as a shareholder and bond investor. And when they looked at their investment books and their exposure to coal, they realized they had an immediate need to rebalance their portfolio away from coal in order to protect the value of the portfolio. But what they also did was focus their attention more generally on coal as an asset class, which wasn't top of mind before that. So their investment, initial divestment policy announced in 2020 was simply to exit the equity exposure in companies with more than 30% revenue from coal. Just 1 year after that, they exited the remaining equity exposure and added 2 more commitments: to exit bond exposure in coal mining and coal power businesses by 2028, and to exclude investments in businesses directly involved in coal. So while they have been a relatively late comer compared to the earlier examples, their actions have been swift. I should also mention that AIA was part of the Insure Our Future campaign led by the Sunrise Project, and so a job well done for the Sunrise Project team. So what does this all mean? Number 1, we have seen and we anticipate seeing continued momentum towards exiting coal for some time. Number 2, we expect the extent of these policies to get tighter and tighter. But as the examples demonstrated, we anticipate more reasoned and nuanced strategies between each of the institution's commitments and policies that are suited to their market and their investee base. But the bottom line here is that this is not a set and forget exercise. And number 3, we anticipate that some of the regions that have been laggards today to increasingly join the party. How they do it is likely to be more market specific, depending on what local issues they're dealing with. And so I'd like to end this presentation with this quote by a classical novelist, Michael Korda. And I found the quote really fitting because it describes our observations. The momentum matters not only by having new policies. Tightening the policy over time is what we really need. Thank you for your time.
Thank you very much, Christina, for that excellent presentation. I think that really underscored where we are with the movement and a lot of the momentum that we're seeing with the financial institutions, different parts of the globe, with their policies and regarding coal investment. So that's helpful. So we'll move on to Richard now. Richard, maybe you could give us just a broad background on the history of the divestment movement and where we are today and where we came from the early stages. That would be helpful.
Okay. I'm going to come up here and show some slides while I talk. See if this works. There we go. There's my name. Oh, it's a great start. So I was at this Bloomberg panel a couple weeks ago in New York City and gave a talk in front of a large group of bankers, investors, analysts, was on stage with Citibank and Natixis. And I have to say, I'm more nervous for this presentation with you guys in the room, who are mostly peers and inspirations and mentors, than I am for that presentation. So I apologize in advance if I appear a little bit nervous. But I want to tell you a little bit about the history of the divestment movement, because I think to know where we need to go in terms of climate finance campaigning, in terms of divestment campaigning, we need to recognize our history. Knowing your history is extremely important. And giving kudos to folks who have built the movement, I think, is also critical for our success. So many people think that the divestment movement started on university and college campuses back in 2011. But I want to take us a little bit further back and recognize the shoulders that the current fossil fuel divestment movement has stood on. So as many of you should know, or I will tell you, is the fossil fuel divestment movement is designed based on the successful anti-apartheid divestment movement of the 80s. And that movement itself was critical to the success of dismantling the apartheid system in South Africa. It was led by black activists and their allies around the world. It was a movement to pull away the social license of companies that were operating in South Africa and propping up the South African government. And ultimately, as we know, it was successful in helping to bring down that awful apartheid system. Following that, in the early 2000s, friends, indigenous friends of mine, and many of you in the room, before the actual fossil fuel divestment movement began, were taking tours of investors around the globe who were financing big oil and gas projects in Canada and in the United States and in other countries around the world, and going to those shareholders in the early 2000s and imploring them to stop investing in tar sands companies, in some of the early fracking companies. And those were the people who really, I think, initiated the spark for what we now describe as the fossil fuel divestment movement, which started on and evolved on university and college campuses back in 2011. That work in 2011 began with Bill McKibben, who many of you know, and a small group of individuals as part of the Do the Math tour, a tour of the United States, looking at the numbers, the harsh reality around the climate crisis, and inspiring activists on campuses to take power within their own hands and to go after their universities, which were heavily invested in fossil fuels. And it was a wake-up call. And it was a call really to moral action, and that the campuses who were kind of, educating the next generation of our leaders should not be investing in fossil fuels that are going to destroy the future of those many students on campus. See if I can get to the next slide here. And this is what it looked like at the beginning. So in the first years of the divestment movement, a small number of divestment commitments started to come out, mostly from liberal arts colleges. Many churches as well, small churches began to make divestment commitments. And we've seen unstoppable and tremendous growth over the years. In the last 13 years of the movement itself, or 11 years of the movement itself, 12 years of the movement itself, an incredible number of institutions have come forward and made commitments. The initial commitments many of them were coal commitments, getting out of thermal coal. And what we are increasingly seeing today is that there are full fossil fuel divestment commitments that are being made by institutions. It's very rare that you see a coal divestment commitment from an institution that doesn't have some language in there as well that talks about tar sands, that talks about fracking or shale oil and gas, or isn't a full commitment as well. What's been also extraordinary to see is the amount of money that we're talking about. So in the early days, we were talking in the low billions of dollars, and now we're a movement that has harnessed $40.5 trillion that are moving out of fossil fuels. And the size of these institutions have changed and evolved over time as well. So where it used to be many churches, many liberal arts colleges, we now have some of the biggest pension funds in the world. We have some of the most high profile and wealthiest universities in the world who have made full divestment commitments. We have, let's see if I can get it. We have a movement that is global in nature. 68 different countries have is some form of a fossil fuel divestment commitment amongst at least one of their institutions. So it really is a global movement that is, when you track the history of movements, to have a movement spread so quickly around the globe, I think is pretty extraordinary. Here are the countries where the top 24 countries where divestment commitments have originated, and the assets under management associated with those countries. As you can see, a lot of commitments out of the United States, out of the UK, out of France, Italy, the Netherlands, lots of big money that are moving in many of those countries. And here are the number of institutions. And this is really reflective of where the movement is strongest, where there has been where it's really seized the narrative in terms of the need to move money out of fossil fuels and the power and depth of the movement. I wanted to mention here in the United States that there is a very active movement, a network of campaigns called the Climate Safe Pensions Network, who are focusing in on the biggest pension funds in the United States, public pension funds. In the previous session, which some of you attended, we talked about California, which is really the biggest divestment fight of our lives, the biggest divestment bill being contemplated anywhere in the world right now, $750 billion on the table that we are trying to exclude from fossil fuels, with just those two pension funds. And we're trying to do the same right across Turtle Island, across Canada into the US, across Canada, across the US. And these are pension funds that have literally trillions of dollars combined in assets that we want to turn off of fossil fuels. There was a couple other things I wanted to mention. Two is that the evolution of the movement. So the divestment movement, I think, has done a lot to spawn and to strengthen many of the campaigns that many of you are involved in now that are not pure divestment campaigns, but are campaigns targeting banks, that are campaigns targeting insurance companies, targeting asset managers. We're making inroads into private equity now. And if you were to track the origin of all of those campaigns, I think you could take a lot of inspiration from the divestment movement that started on these small campuses, in many of these churches. And collectively, the amount of power that we are shifting is pretty extraordinary. I know that from previous presentations, when we see the growth of LNG, we see the growth of methane gas, we see the CapEx spending of some of the big oil and gas majors going up in the last year. It can feel hopeless. But when you look at the map and you see the number of institutions who have made commitments to divest, when you recognize that you've got the biggest pension funds in the world, like ABP in New York City, Baltimore, Chicago, who are all divesting from fossil fuels, when you see the biggest universities like Cambridge and Oxford and Harvard, who are all committing to divest, when you see the science and the passion and that the argument has moved from a moral argument to a financial argument to divest from fossil fuels, I hope you take hope with that, because this kind of societal change doesn't happen overnight, and the fact that we've come so far in just 12 years is pretty significant. So thank you to all of you. Back to Mark.
Thank you very much, Richard, for that background piece. That really shows how the movement has grown significantly over the years. I mean, $40 trillion, that's a significant amount of capital globally, definitely. But with progress, there has also been pushback. So I was wondering if you could perhaps touch on some of the counter arguments that the movement is encountering globally, and also maybe what sort of strategies that campaigners can employ going forward to counter some of these pushbacks that we're seeing.
Yeah, I talk a little bit about that. I mean, the success of the movement has engendered pushback as well, and I think that's an affirmation. As a campaigner, I love seeing my opponent on the defensive, and I love seeing them start going on the offensive because of the success of the work that I'm doing and that all of us are doing. So the fact that we are seeing now the rise of the anti-ESG backlash in the United States, going all the way up to the White House in terms of it being an issue, that there are laws being passed in states like Texas and Oklahoma to stop doing business with some asset managers and banks that hardly are doing very much on climate at all, but have thrown around the word divestment or ESG. Is really an affirmation of the success of the movement. It's the fact that we are having traction, that you have Shell, that you have coal companies saying that the divestment movement itself is a material risk, is really confirmation that our theory of change is the right theory of change, that it is successful, that it is having an impact. And so, just last month, many of you may have seen that a lawsuit was filed in the Supreme Court in New York against the New York City pension funds for having divested from fossil fuels. We expected this lawsuit to have dropped many years ago when, in 2018, when New York City first announced that they were going to be moving $4 billion out of fossil fuels. It took them a long time, our opposition, to file that lawsuit. I'm sure it's not going to be the last lawsuit. We can expect copycat lawsuits to be launched against other cities like Chicago and Baltimore, maybe the state of Maine who's moving ahead on divestment. And that really is a result of the fossil fuel industry being scared to death. They are, as I said, they recognize our movement as a material risk. They see the flight of capital out of their companies. They see, the writing on the wall, and while it can be, they will pull out all the stops, including buying off politicians, as they've done in the past, to try to stop our movement. So I take some pride. I think we should all take some pride in that, but I think we also need to double down. We need to double down on pushing back on this anti-ESG backlash. We need to be highlighting, that considering divestment and moving forward on divestment is actually a fiduciary responsibility. To not do so is a violation of fiduciary responsibility. I think we need to be considering things like lawsuits to push pension funds and other entities to move ahead on considering divestment. And I think we also need to be doubling down on our successes. So, coming back to where we are right now in California, winning divestment in California can be one of the best responses to the anti-ESG backlash. We need to win here to send a message that we are unstoppable. Thank you.
Thank you. So moving on to Jackie. So thus far, the divestment movement has largely focused on institutional funds and investment portfolios. However, there is a larger fight against fossil fuel expansion, and that's led to efforts like Stop the Money Pipeline, which you're a director of, which aim to restrict pipelines in new oil and gas fields, especially in indigenous communities. Would you say those two movements, two struggles are aligned or parallel or related? And can you maybe touch on how these two movements are intertwined in certain ways?
Yeah, so, well, thank you, Richard, for acknowledging the history of the divestment tactic specifically coming from South Africa. Divestment is a tactic for communities who are on the front line, who have their backs against the wall and have been in that position for generations. It's a tactic of last resort sometimes, it's a tactic of desperation, but it's also a smart tactic, as we've seen with other movements. And so, as for myself even, I'm an enrolled member of a small tribe in northwest corner of North Dakota that is home to the start point of the Dakota Access Pipeline. And being here in San Francisco during the Dakota Access Pipeline movement, I really wanted to have a way to be involved, and I couldn't go and stay there for a long time. So I actually found that there was room and actual community to join in the divestment campaign world. And so taking a page out of the book from Matt Remley and Rachel Heaton in Seattle, who were pushing their local city council to break up with the banks that were behind the pipeline, I started that group here in San Francisco trying to do the exact same. And so it's a tactic for asserting indigenous sovereign rights. It's a tactic for achieving liberation for people all over the world who are facing oppression and exploitation. And I think if you get anything from this panel today too, is I hope that you also see it as like a recruitment tool, recruiting people from all different kinds of backgrounds, from all different skill levels, whether they are climate experts here at IEEFA, or whether they are, mom and dad on the street who really just have so much on their plate, just trying to survive in our modern society, but still think that there's something we should do that everyone should be able to do to show their support. And, it's also a tactic because when we try to go to the federal government, for example, for the Dakota Access Pipeline, we had to go to the U.S. Army Corps of Engineers. This Army Corps of Engineers is a bureaucratic institution that has their preconceived, rules and whatnot, and they don't recognize the whole framework was set up so that indigenous communities can't win in that system. And so it's really it's the only option in that specific movement that I think we had to continue the fight alongside the lawsuits. And then, talking about the Gulf South and the massive LNG build out, shout out to Rochetta, Ozan, who's here at this conference, and our Gulf South partners who show up like every month, it seems, to DC to try to be heard by FERC, the commission that approves all these projects. And they share their stories. They take the time. They leave their families for weeks on end to go lobby these commissions, and it just consistently falls on, the bureaucratic institution that has just been so obstinate to change. And so divestment is an empowerment tool as well. And I think we've been so successful at putting morality and environmental justice and racial justice at the forefront of the fight for climate justice that the banks finally felt the pressure, and a confluence of factors, a confluence of organizations, institutions, researchers, all of us here. I think a confluence of movement pressure and knowledge had just come to really a really amazing momentum, and we're finally getting climate policies, as we've known, from all the banks, and are still continuing to do so. But of course, the fossil fuel industry had to fight back in some way. And it's not like they popped up overnight. They were trying this kind of like energy discrimination framework and rhetoric around, discrimination against energy companies, fossil fuel companies. And it wasn't really sticking until it seems that it perfectly coincided with like the anti-woke backlash. And it gained so much momentum in 2021, and last year especially. There's over 130 bills around state legislatures. Depending on how you see it, it was successful in some ways and unsuccessful in a lot of other ways. They passed more than 20 bills, but their bark is kind of bigger than their bite. The combined amount of funds that they've been able to leverage in their reactionary movement is actually still dwarfed by funds in states like California and New York, who are supposed to be, and in some ways are, climate champions, environmental justice champions. And as we know, because the fossil fuel industry is everywhere, there's also a long ways to go in these states. And so, I think right now we're in the middle of a really important fight here in California. We have, of course, SB 252, the divestment bill, that is winding its way in the legislature. And there's also two other bills, SB 253, which has to do with disclosing the entire emissions of the life cycle of products for companies that have over $1 billion in revenue. And then we also have SB 261, which requires corporations, financial institutions, and other businesses to annually disclose to the California Air Resources Board their climate-related financial risk. And that's for companies who have more than $500 million in revenue. So I think there is hope and promise in exactly where they're putting their efforts. They're putting it at the state levels because they don't exactly have full control of Congress. It's important to note that Biden's first veto was about climate finance. It was about that silly anti-ESG bill or whatever that they had going. That was his first veto of his term. So it's gotten to a fever pitch level, but at Stop the Money Pipeline, we're talking to a number of state groups that have been pushing for bills like this and really invested in trying to get more support, more movement, attention in general. And I think, divestment as a tactic, as a recruitment strategy, in this world, it's really easy, in the policy world too, I think it's easy to get stuck in the mindset of, well, if A, then B, then C, then D. When actually, if we're talking about divestment, take, for example, the Dakota Access Pipeline. One woman went to the Dakota Access Pipeline protests in 2016, and she ended up running for Congress. She ended up winning. I'm talking about Representative Alexandria Ocasio-Cortez. She ended up winning. She ended up, for a moment, and partnering with Sunrise Movement, was able to draw a lot of media attention to the climate movement, and was able to push, at least use her bully pulpit to talk about the positive vision, the Green New Deal. And so it was not exactly A, then B, then C, then D. It's also just full circular. And so all tactics, we need the positive vision. We need to also know how to draw a line in the sand. I think we also need to recruit the right communicators who have platforms, who can take our like wonky facts and really sound strategies and take it at the right moments. We're gonna be in the middle of hurricane season, we're approaching fire season. There are these moments where the general public, the media, have to talk about climate change now. Everyone who is working in the fossil fuel finance world knows how notoriously difficult it is to get banking reporters to talk about climate-related financial risks, talk about fossil fuel investments and all these other things. And so I think we need to, push in these really crucial moments. We need to push, the positive vision. We need to push the tools and the research and the data that we have, find the right communicators, find the right decision makers, and I think that's how we counter this really well-funded, well-coordinated effort on behalf of the fossil fuel industry to stop the financial institutions from making real climate progress and protecting indigenous rights. So with that, I also just want to say, really appreciate the frontline folks who have been so gracious with their time with all of us in the movement to not only fight the projects in their backyards, but also to be on the learning curve with us around the fossil fuel finance world. And I think that's where our strength is. And so I hope you share that vision too.
Thank you. Thank you very much for that, Jackie. So we'll move on now to Lucy. Your work with Reclaim Finance is mostly centered in Europe, a lot of successes over there. Maybe you could give us some perspective from that side of the world and what you see in the divestment movement, how it has evolved, and where you see where we are currently.
Sure, thanks. I'm sorry, I will bring a more gloomy picture about our movement and what we are facing, and I will raise 5 risks in particular, maybe 3, I will add 2 if I have time, but also how does it inform new strategies, what can we do about it. At Reclaim Finance, we are tracking and assessing the policies adopted, not by the whole financial institutions, by university and other. We are only focusing on banks, insurers, and asset owners and asset managers, institutional investors. But what we have seen in the past 2 years is that the momentum is decelerating. We have more financial institutions with policy, but the number of policies adopted every year is decreasing, and the quality of these policies are still missing. And for example, to just take 2 examples, we have still a lot of policies that are excluding only companies that are listed in the carbon underground. The carbon underground is 200 companies, and what we know, thanks to Urgewald work, thanks to the global coal exit list, and thanks to the global oil and gas exit list, is that this industry are made of thousands of companies that are today not being covered by many policies adopted by financial institutions. We also know that there are still a lot of policies, for example, for the coal sector, that are only excluding companies that generate, for example, more than 20% of their revenues from coal production. And what we know, again, thanks to the global coal exit list, is that you have dozens of companies below this threshold that are among the biggest coal producers in the world, or that are actively building new coal assets that have no room in the remaining carbon budget. To name only one company, Glencore does not generate more than 10% of its revenues from coal, but it's the 9th biggest coal producer worldwide, and it's developing new coal mine. And we need to be very careful about not only asking for fossil fuel policies, we need to add for strong, impactful fossil fuel policies. And as a movement, we are very diverse, and we cannot expect the frontline communities, the grassroots movement, the youth movement to actually become like experts in this type of policies, but it means that we need to be better in collaborating with each other, in equipping our movement with the right demand and the right understanding of the value and the quality of the policies adopted by financial institutions. So that's one thing that we are doing in France, collaborating with Extinction Rebellion, with the youth movement, with other NGOs that are pressuring banks such as BNP Paribas and Crédit Agricole on the quality of their policy and pushing them to adopt policies against oil and gas expansion. Even this morning, Greta Thunberg had a meeting with Crédit Agricole to discuss Crédit Agricole oil and gas policy, and we had a briefing before to make sure that they knew exactly what was going on internally. The second thing is, it's something not new to this, to our movement, is that engagement is still very high, a very high narrative, which is pushed by many investors to postpone action and to postpone the exclusions of policies. And for me, when we are fighting something, it's better to just go beyond the line of division that some investors are trying to draw between opposing engagement on one side. There will be the investors that do the hard work, that do engage with companies to make them transform their business model. And there are the other financial institutions that don't want to do the hard job and that are just like washing their hands and excluding companies. And I think this obviously sterile opposition is playing in favor of the business as usual, of the statu quo. So we actually need to be more clever than that, and we need to make sure that already now our main purpose is not necessarily to exclude all companies from the portfolio. What we really want right now, if we want to reduce greenhouse gas emissions, is to have no new money, no new capital going to companies that are in expansion, that will use this money to build new coal projects or new oil and gas fields. And we can ask investors to stop purchasing bonds in these companies while remaining a shareholder of these bad companies and making noise during the AGM season. And that became very clear to me when we started campaigning in France on Total and on the oil and gas industry. We had investors really engaging Total in the oil and gas industry, not investors talking about engagement, but investors that were really putting clear demands on the table with an escalation strategy if the companies were failing to meet these demands. And these investors, after 1 year or two, they were telling us, oh, I want to divest from Total. And we were, if you do, who is going to make noise during the AGM of Total? Not Amundi, it's definitely not. So I want you to remain a shareholder of Total, but yes, I don't want you to put new money into the pocket of Total, because that's going to go to ECOP or to new oil and gas projects that the company is developing. And also these strategies kind of work. We have around like 10 to 15 investors with policies like that, and it's hundreds of billions of investment of assets where no new money is going to oil and gas expansion. It's just CNP Insurance, for example, French insurer, one of the first ones to have committed not to buy new bonds for the oil and gas expansion, is managed more than 360 hundreds of billions of dollars. So it's quite significant number. Another risk that we are facing, explaining maybe why we have less policies being adopted on top of the anti-ESG movement, is the fact that the new trend, what is fancy right now for financial institutions, is to adopt decarbonization targets. To adopt targets to monitor the decarbonization of their overall portfolio. And at first sight, it looks good, right? I mean, we do want you to cover the whole portfolio. You might have targets that seems pretty much aligned with a net zero scenario for 1.5. So it's good, but there is an issue with that. Is that what's happening in the portfolio of a financial institutions is not necessarily what happens in the real world. And you can have banks such as Crédit Agricole that have several types of decarbonization targets, including oil and gas targets that seem pretty much okay. So it's 2030 targets. But in the meantime, they can still provide loans or issue bonds for companies that are gonna use this money to develop new oil and gas fields for two reasons. The first reason, if you make a loan to an oil and gas expansionist, the loan is gonna be paid back in 3 to 4 years. So the emissions related to this loan are not in your portfolio by 2030, but they are in the real world. You also have banks issuing bonds for these companies, and the bonds are off the balance sheets. They are not in the book of Crédit Agricole. So Crédit Agricole is not responsible for these emissions. Also, what we have seen also from Crédit Agricole is like last year they made a loan to Saudi Aramco, and a year later they securitize it, they transform it into a bond, and they replied to us and said, yeah, it's part of my decarbonization strategy. Hop, I'm taking the emission of my portfolio, and I'm giving these emissions putting them in the pockets of investors. So I'm not saying that decarbonization targets are not good, but they're not good enough. And we need to make that very clear and to fight the financial institutions who like to pretend through this adoption of decarbonization targets that they are taking action on climate, that they are actually not. They might manage a risk of their portfolio in the medium term, but they are actually not preventing the world of heating up. And the way to do that is through the bond campaign again, or exposing every time a financial institution with targets is making a new loan or is issuing bonds or buying new bonds of companies with expansion plan, we need to say it very vocally. We need to make it known that that's business as usual. So that's what we did last month. We saw Crédit Agricole is one of the many banks. I decided to target Crédit Agricole today, which they supported BP after BP watered down their climate commitment. So we make it known in the press. Then they supported the week after a bonds issuance by another company that is still expanding its oil and gas operation. So we made it also that public. And what is interesting is that it might actually start working, because who has not been participating in this BP and any issuance, bonds issuance? BNP Paribas. It's not written in BNP Paribas policy, but BNP did not support this bonds issuance. And which is strange, because BNP is the first banker up to now of both BP and Eni. And they're not supporting new bonds issuance for this company. And we do believe that it's thanks to this campaign that we can start having some impacts on preventing the new money to go to these companies. Another thing that I would like to raise, and I know it's quite a sensitive issue here, is it's not known. A lot of people who knows me is that I don't believe in market-based approach, and I don't really believe that the financial argument is the argument that is really allowing us to win. Because yes, there is climate-related financial risk, that's for sure, but today, we see a lot of investors and financial institutions that are still profiting of the oil and gas industry. And we all know, because we might agree with Mark Carney at least for that, is that financial institutions think very short term. They take their decisions on a very short term horizon. And in the short term horizon, there's still a lot of money to be made from the fossil fuel industry. So we might use the financial argument, but that should not be the main angle of our campaign, because there might still a lot of money to be made of fossil fuel in the future, especially at project level or at companies level. So it needs to come on top of other arguments, and it needs to come on top of other arguments also because pushing for financial based policy will not make us work. Again, using the example of the coal policies that we have seen, when financial institutions exclude companies that are making more than 20% or 50% as they used to be of their revenues from the coal sector, indeed, they are protecting themselves from the financial risk related to the coal industry. But a company which is building new coal mines or building new coal plants and making only 10% of their revenues from coal is not risky or is less risky, but it does have an impact on climate. So we need to advocate for the right type of policies, and maybe actually that's the main way of preventing the climate chaos and so preventing in the long run financial risk. And we see that this type of argumentation is actually being supported more and more by some institutions with the primary mandate is actually to protect financial stability. The central banks themselves. Central banks are only interested in protecting the financial stability, but they do acknowledge that this financial approach is actually very hard to put model on. It's very hard to know exactly how the financial risk is going to be having impact on financial portfolio because of the tipping points, for example. How do you bring a model about tipping points? And you have analysts from central banks that are saying, if we really want to protect the stability of the financial sector in the long run, if we really want to protect the capacity to do profits, for financial institutions, we need to have a precautionary approach. And a precautionary approach is wonderful because a 40-year-old kid can understand it. That's the basis and that's the heart of the divestment movement. If there is no room in the carbon budget to build new coal plants, stop financing them, full stop. Stop financing companies that are building these coal plants. So it's something that we need to think really twice. Like, the more our argumentation has an impact on the type of policies that will be adopted by financial institutions. And maybe one last thing, but very short, a trend that we are seeing right now, it's very small, but we are worried about it, is that some policies are badly implemented. Or some policies are also, some financial institutions are backtracking on their commitments. So it means that as a movement, we should not only fight for pushing financial institutions to adopt policies and good policies, but we need to make sure that we monitor how these policies are being implemented, and we need to make sure that the integrity of these commitments are being maintained. And maybe that we might want to do, because obviously we cannot chase like hundreds of financial institutions to adopt policies and to track how it's being implemented. It takes a lot of time, and we have other things to do maybe. And one thing that we might want to do is to target more of the regulatory agencies, because the regulatory agencies have for responsibility to make sure that there is no false allegations to the market. And if a financial institution is promoting its exclusion from the coal sector, we should make the regulatory agency go after these financial institutions if they keep supporting the coal sector. So that's other targets that we might want to add to our movement, bring the regulatory agencies on our side, or if they don't do their job, target them. And I will stop here.
Thank you very much, Lucy. We're going to open the floor now to any questions from the audience. I'll just go ahead and kick this off. You also mentioned that there's been some sort of backtracking and loss of momentum with organizations that are committed to doing some sort of divestment, and then they change their minds. How much of this is related to the recent rally in oil prices that we have seen in the past 2 years? Is it purely economic factors at play, or is there something more fundamental that's changing, that's driving these backtracking that we may be observing? And that's open to whoever.
That's a very good question. I wished I had a clear answer on that. Unfortunately, financial institutions don't tell us why they are backtracking. But what we might guess is, to take an example of a French financial institution, is Crédit Mutuel, which committed twice, not once, but twice in 2021 to stop supporting oil and gas expansions. And actually, in December 2022, they finally clarified the criteria, and there was no criteria whatsoever on oil and gas expansions. And obviously, it allows them to keep supporting a very nice value of the French stock market, which is Total Energies. And we know Total Energy has been pressuring a lot French financial institutions not to adopt strong policies. As Richard was saying, we are powerful, and the industry is fighting back, both during the EGM, but also in regards to asset allocation. So that's one reason. And I guess the fact that Total is bribing its investors with a lot of dividends is actually also giving ammunitions to those internally inside Crédit Mutuel, which are opposing this type of exclusion policy, or opposing the decision to stop buying new bonds from Total. And I do believe that it raises the fact that we are not only talking about institutions. In each institutions, we might have a lot of allies that are pushing in the right direction, and we might have a lot of people that are pushing on the other hand. And so we need to also take consideration of these divisions internally to support those from the other side, which might be fighting for progress. But we do believe that it's two reasons. The first reason, it's Total putting pressure, and the fact that their industry is doing very well is obviously helping them to make an argument.
Okay, thank you. Any questions? Okay, please, can you just come forward and introduce yourself and organization, please?
Hi, I'm Pierre Kühne with Leave It in the Ground initiative, Lingo. And I have a question about fossil gas divestment. I come from the climate side of things. And you may know that methane is responsible for 0.5 degree of the heating that we're seeing right now. But methane is also a very interesting substance because it washes out of the atmosphere very quickly. So after 7.5 years, half of it is gone. So that means if you cause methane emissions today, you're responsible for tomorrow's climate impacts and heat waves and forest fires and whatnot. So there is a very direct link between fossil gas, which is responsible for a significant part of the methane that humans put in the atmosphere, and the climate impacts happening right now. So you could say half the methane in the air is from after Paris Agreement was signed. And so this direct link between fossil gas emissions and climate impacts is not yet being made. It's still talked about as natural gas and as bridge fuel and necessary for the energy transition and so on, but I think that link could be made. And we have been suggesting that because of that reason, and because fossil gas and methane being an actual tool that we could use to even bring temperatures down. It is something that humankind will turn to in the climate emergency, because it's the thing we can do. With CO2, it's going to be in the atmosphere for a long, long time, but with methane, we really can do something about it in the short term. So we said it's a climate emergency. We need to do something, and every disaster reinforces that need to do something. So fossil gas will be on the list, and it's going to be the one that's going to go down next after coal. So my question is, how can we learn from the successes of the divestment movement on coal and repeat those for fossil gas, but quicker, because we're on a short time frame? Thanks.
I think you make an excellent point. And what's unfortunate is that the fossil gas industry is a much stronger industry than the coal industry. You know, even when many of us, the old timers in the crew here, started working on coal divestment 12 years ago, 13 years ago, the coal industry was in decline. And you look at the value of the coal industry at that time compared to the methane gas or the fossil gas industry today, and you see, you know, a large gap between the two. So we're up against a harder industry. I would say that they probably have more political power than the coal industry had as well. But we're also seeing increasing climate impacts, and more so every day, and it's hitting virtually every corner of the planet. You know, in Canada right now, we've got fires burning coast to coast, smoke traveling into New York City, turning the sky orange. The smoke is traveling, or I think just hit Norway, across the Atlantic Ocean. So those climate impacts are ones that we need to tie to the fossil gas industry. We need to talk more about the health impacts that industry is having on Gulf Coast communities, for example, and accelerate the action on fossil gas. I think it's, you know, connecting it to the methane, the warming potential of it, I think is extremely important. And as you said in I think it was yesterday morning's presentation, talking about what the equivalent impacts are in terms of numbers of people who are dying as a result of the emissions caused by fossil gas industry, the fossil gas industry, and what that means for a pension fund who continues to invest, you know, hundreds of millions of dollars in the shale oil and gas industry. I think those equivalencies or that comparisons are extremely important. And that's where we can bring in the moral arguments while also bringing in the financial arguments at the same time.
Maybe if I can add, just to add a bit, what we are missing is clearly like data and information also about the use of the gas. Coal was quite easy. Indeed, and the fact that, as we saw yesterday, gas is not only used for the power sector, it's used for the industry, it's used for the heat, and it makes the argumentation against gas much more difficult to bring publicly, and especially considering that we need to build, pressure from the outside, but also when discussing with people internally within financial institutions, it means that these people have a lot of catch up to do in terms of what are the alternatives, not only for one sector, but for all this use of the gas. In Europe, what we have seen is that oil is it's much easier to campaign against oil than against gas. It's quite actually funny because to see that BNP Paribas has very strong targets on oil, and they say they don't want to finance oil beyond 2030, while they are saying we need gas because gas is a transition fuel, which is definitely not science-based because oil is supposed to remain in the energy mix longer than gas. But that's the argumentation that they are displaying, and obviously the adoption of the EU taxonomy is definitely not helping. So one thing that we need to do is to prevent other countries to align, which are considering adopting a taxonomy, prevent them from doing the same mistakes that we have been doing at the EU level, mostly thanks to the French government. So prevent the integration of gas in these taxonomies. And what we are starting doing in France and Europe is to actually frame our campaign not anymore against oil and gas expansion, but really against gas expansion. Because when we say oil and gas expansion, everybody hear oil, and they don't hear gas. So we need really to just like reaffirm that gas needs to go.
Thank you. Okay.
Great conversation. Thank you so much. I have so many questions. I'm going to just try to pick a few of them. I think that one of the things that's really interesting, we do a lot of bank engagements as well. My name is Osprey. I work with the Women's Earth and Climate Action Network, and we do divestment delegations with frontline leaders. In fact, Jackie was on one of our delegations. So I'm just curious about some of your bank engagements, those of you who've had them, around conversations you've had with banks about their appetite for making moves around exclusion and divestments without government regulation. Because of course they always are hiding behind that. That's not their job. Governments are there to regulate. I'd love to hear just conversations, insights into that particular strategy, because we do see ESG teams who want to move forward, and then the government has the door open for them so they don't move. Another component is we have been asking banks about, in the same way that we ask governments, what actually is your fossil fuel phase out plan financially? You know, you've made a lot of these commitments. We saw you at GFANS, all these commitments that are being made. What does it actually look like? Would you spell that out for us? We're asking governments to do this. What is the bank phase out program financially? So I'd be curious about that. And then just a few other quick points. You know, we often work with banks talking about their risks, and you know, of course, they're talking about risks to them financially because of the climate crisis and impacts. And we're asking them to expand the definition of risks, like risks to the environment, risks to communities. And of course, they're very, they don't have an appetite for that. But we're also saying if you think long term, you won't be doing any business anyway, because there won't be any community or an environment to do business on. So we really think you need to define risks in a different manner. And I'll leave it at that. Thank you very much.
I can maybe start us off and take the first question around exclusion policies. And I will contextualize this just for a recent conversation with a particular US bank when we met with them and asked them if they would be considering an Amazon oil exclusion policy. So this is a conversation with Citibank, #1 financier of the Amazon oil trade, which opens up the Amazon to deforestation pressures from other sectors as well. Huge impacts on indigenous communities in the Amazon basin. And the first thing that Citibank, very concerned about their ranking as the #1 Amazon oil trader and financier, but when asked if they would pass an exclusion policy, they very much, pretty upfront said, we will not pass in this current environment another exclusion policy and paint a target on our back. Because Texas will come after us and Oklahoma will come after us. And so we may do something, but you will not see an exclusion policy from us. And that might not be the same situation that we see in Europe, which I think we continue to see progress in terms of adoption of exclusion policies or limiting policies, perhaps not strong enough, certainly. But I think there's definitely a chilling effect that's happened with the US banks, which again, you know, is an affirmation of the work that we're doing, but is a roadblock that we will need to somehow overcome with some of these US banks as well.
Maybe just to respond or give thoughts, because it's not a clear answer about like the role played by governments policies. Obviously, like to have a government really pushy and putting pressure on its financial institutions is a good thing, but what has been decided at the government level is not necessarily supported by the all branches of the government level neither. So we have seen, for example, very bad example from the French government recently. The first one is the investors have been filing a resolution at ENGIE AGM this year. This resolution was supported by 43% of the private investors, but the government voted against. The government voted against despite the fact that this resolution is just asking ENGIE to adopt a climate plan, very detailed, and to submit it to a vote, which is actually very aligned with a piece of law that has been adopted 2 years ago in France, but the French government itself is voting against. So that's one thing that we are seeing. We also see that what has been decided in previous years can be undone. So that's, for example, the case of the French behavior in regards to the Rio Grande LNG terminal in Brownsville in South Texas that many of you know about. French banks started supporting first and then withdrawing from the project since 2017. We got Societe Generale, which was advising the project, withdrew last year. They made it public this year. We have also BNP that is out since 2017. We have Crédit Agricole, which also say that they're not going to finance it. We have investors asking both ENGIE and Total, which have signed purchase agreement, to not do that and to adopt like gas phase-out strategies. And then what is the government doing? Back in 2020, the government opposed ENGIE's signature of a purchase agreement. And now they are actually not only embracing the contract, but Macron went to meet Biden like a few months ago. And who was with him? Pouyanné, the CEO of Total, and it's not a surprise that Pouyanné and Total just got in the projects last week. It's really the consequences of this business trip, diplomatical trip, as they say. So yes, of course, government can be allies and they can push for more action from the financial industry, but we might also have sometimes, and that's the case right for these two examples, we might have private financial institutions that are actually more progressive than public authorities.
Hi, Hannah Heineken from Client Earth. I have a question about transition finance. So, a lot of banks and investors are saying that they would like to support the transitioning of fossil fuel companies. Obviously, that is impossible for a lot of companies that are not diversified. But there is, we're seeing increasing amount of loans and bonds that are labeled as transition, going to not only fossil gas, but also things like carbon capture and storage, direct air capture, ammonia, and hydrogen co-firing. So I'm curious, one of the arguments that banks make is that, well, if we're helping our clients transition, our financing to fossil fuel companies might go up, and so we're being penalized for that. But in fact, we're actually doing good for the climate. So want to hear your thoughts on transition finance. Thanks.
Well, I can go on this. It's not going to be very long because transition finance is a very controversial topic. It is true that, and I've also heard similar concerns from financial institutions. Forget about oil and gas or those that are transitioning, even managed coal phase out, right? Early coal retirement plants. There are a number of financial institutions who have been pushed to support the move to phase out coal early, but they are really worried about that financed emissions on their books. So it is true. However, I think there is some mechanism that's being considered right now around how you could manage that financed emission in your books, and it's really around presentation and the disclosure of how providing more information around why your emissions have gone up. So I think it's as simple as that, I think, for the time being. Yeah, but it's a real concern. I'm not sure if on the panel.
Yeah, I mean, I can add to that. I'll probably talk a little bit more frankly and just say I think it's bullshit. I'm speaking more about Canadian and U.S. banks. Many of those banks have set up transition teams. They've renamed their energy divisions or their energy units as energy transition units. Their climate reports, their ESG reports, their annual reports, or you do the search for the term climate and transition, and it's popped up more in the last year than it has in any previous year. You've got the CEOs, the chairs of the board, who are also just spewing out the word transition. We need to stay involved with our clients. But then you look at the deal books, and you look at the details of the loans and the underwriting that they're doing, and there's nothing in there about transition. And some of them are sponsoring units at universities to talk about transition. I think it's just lip service. It's pure PR. It's climate advertising. It's greenwashing. Call it what you want. They are not helping their clients transition. What they are doing is making excuses so they can continue to make short-term profits off of the billions of dollars of deals that they're doing with some of the most awful fossil fuel companies on the planet. And we need to call them on that. And what we need to do is we need our lawyers in the room to start suing the bastards, because that's how we're going to get them to change and stop doing this transition bullshit. And apologies for swearing.
Hi, Rory Abernathy, United Educators of San Francisco. So I want to know, when you're talking about all of these things, I do know we have problems with the Democratic Party taking oil money, and I love all of the data, which I'll be taking back and sharing with my members at the state and national level. But is there a directory that says which Democratic politicians and even Republican politicians have investors from oil, so that we can hold them accountable and start highlighting these people, calling them out? So I just wanted to know if there's any sort of organization or directory that keeps track of that, so that when they come to us and they say they're pro-climate, that we can, really question where they're getting some of their financing from. Thanks.
Maybe. So I don't know that there are specific organizations that will do it consistently, that will publish person by person, legislator by legislator, how much in totals. But as someone who is very interested in all of that, I regularly go to the California Secretary of State website, and they have an advanced search tool where it takes a lot of time is the thing, but it is worth it in my view. You have to know which companies to look for, first of all, whether that's Sempra or Exxon, Chevron. And I don't know how it works in other states. If other people do, that'd be great knowledge to share around, but I am totally in agreement that every single legislator from local, state, federal government needs to have that specific stat blasted out everywhere, because we know you can run for office and not accept that kind of money, and that is exactly why we're running up against so many different blocks. And they will say, it's not a priority, or but all the different reasons and all the different talking points we hear from the fossil fuel lobby. But But absolutely, and you know, with respect to SB 252, the divestment bill, there are so many California politicians who will talk about being for the climate and being for environmental justice, communities of color, and then because no one's looking, no one's blasting that information out, they can get away with accepting all this money. So I appreciate you and the question.
Okay. Have him and then you after.
Well, I'm a bit tall for this microphone. Pick it up. I'm Brad Adams. I was Asia Director at Human Rights Watch for the last 20 years, and I've just started an organization called Climate Rights International to bring that kind of methodology to this field. And Lucy, I spent 20 years fighting with Total in Myanmar and have the scars and share your pain and experiences. My question, well, was observation and then a question. Observation is that if we had a Venn diagram of the countries that have been identified as current and future carbon emitters based on population and actual emissions, it would almost completely overlap with rising authoritarianism. So you have China, of course, Vietnam, Pakistan, Bangladesh, India, where Modi is being feted ridiculously at the White House today, where they're whitewashing all of his past sins. Even places like Indonesia, where we have a project right now where it's an open society in some level, but if you actually go to places where there is activism to oppose new projects, whether it's a coal project in East Kalimantan or a nickel project for electric vehicles, the police will come and they're basically being outsourced by companies to attack people. So my question is, it's a truism that a big part of the solution will be bottom-up, grassroots organizing, pressure from localities, that the solution will be both international and national. The national part's going to require space for activists and media to do their work, hold people accountable and put pressure. So my question is, what is the appetite for the climate finance community and everybody related to take these on, to move out of their comfort zones in a careful way? Because I'm not asking everybody to be Human Rights Watch or do what I do, but my observation for many years is that whether it's development organizations or other people who share values that are in different institutions, they're super nervous about taking these things on and risking their own access and their own space. And as somebody who's new to this community, I'm very curious because even in the just transition discussion earlier today, there was no real mention of civil society. And I'm just wondering where you all see it, particularly in unfree and authoritarian societies.
Yeah. I think it's a very good question, but I think it's also the beauty of some financial strategies is that you can fight what's happened in some countries in support of the frontline communities without having to be in these countries. It doesn't mean that we should not be careful, especially when communicating with these communities, without which we cannot actually do our work because they are the first provider of information that allow us to lead our campaign. It doesn't mean that we should not be also careful because even to take a country which is not as, if there is a hierarchy between how bad they are, maybe Uganda is not that bad, but still when human rights and civil society, different grassroots representatives are going to France to raise awareness against ECOP, some of them then have trouble at home, and so we need to indeed support them, but pressure can be raised from outside these countries, and I think it's important for all movement to tell these stories and to tell that we are not fighting fossil fuels because of a level of CO2 in the atmosphere. We are fighting fossil fuels because it's a main driver of human rights violation and of conflict. And expose this situation. And you spoke about Myanmar. We could name also Mozambique, where the whole country has been destabilized, partly because of Total and Eni and other companies' LNG operation. We know unfortunately, that the situation is going to be very risky in the frontier of Lebanon and Israel, where, oh great, they have settled an agreement about the border, and so Total is moving forward to open new fossil fuels operation there. In this context, we know it's not going to look good already. Knowing the political context of the region, we know it's going to be bad, and that unfortunately the population are going to be the first impacted.
Okay. I think I'll just mention something quickly. In some of these sovereign countries, you just have to be really careful. A lot of the times the fight might have to be from external countries that are safer, but in terms of local organizations, there is a risk, and it's a real risk depending on what administration we're talking about. So depending on how serious it is, we might have to have strategies whereby there are external organizations where in safer, more developed countries try to put pressure from the outside. That's the only realistic way to go about it, without putting people at risk and things like that. So, yeah. Could go ahead. I think we'll have just this question and then.
I'm Janet Cox from Climate Action California. And what I'm wondering is what you think of the possibility that the lawsuits that are now moving forward in state courts after the Supreme Court has decided not to take the oil companies' bid to keep them in federal courts can actually succeed and move the needle. Some of us are thinking that California should be suing, Los Angeles County should be suing, and maybe every other coastal community from the Mexican border to Canada. But what do you think of those odds?
I'm not familiar with the federal. I'm not sure. I haven't been keeping up.
I can jump in on this. Yeah, I think the fact that the decision was made, I think it's, from my understanding, is a positive one. That there's just a greater hope of success. I think the climate lawsuits that have been launched, they are part of the ecosystem of tactics and tools that we need to use. On their own, I don't think they are going to lead to the type of significant change that we need to see. But I think together with all the other work that we are doing, they are creating the political space. They are driving the media narrative. They're certainly raising awareness. They are creating divisions in the right way that we need to see on these things. And they're scaring the heck out of the fossil fuel companies. And they are certainly making it an issue that makes it easier to make the financial case to many of the investors who are investing in those fossil fuel companies. So in many ways beyond just the legal decisions that will come, and I'm not a lawyer, I think they are having a positive impact. And we will see that impact increase quite a bit now that they have the opportunity to move forward at the state level. But there are lawyers who have worked on many of these lawsuits here, including city attorneys, and you should probably ask them.
I'll do the same thing. I'm Suzanne Mattei, and I work for IEEFA. I am an attorney. I think the exciting thing about the Supreme Court not accepting jurisdiction, about turning these things back to the state, is the diversity of that. Every state's history of common law is different. Every state's consumer protection statutes are different. So a victory or a loss in one state doesn't dictate what's going to happen in the next state. And that means there's lots of opportunity for activism. There's lots of opportunity for these litigation efforts. Some of them could result in discovery, disclosure of information. That's probably the most valuable thing that could come out of these lawsuits. So I think there's a lot of opportunity there. And it's important to remember that the states do have a basis in common law. And the concept of common law is that everyone owes everyone reasonable care to not harm them. It's a really basic value, and it's something that applies here. and it carries a moral imperative, but also a historical imperative of what justice is. So this is where you can really talk about what climate justice really means.
Thank you. Thank you, Suzanne. So I think with that, that wraps it up for us. I want to thank the audience for sticking around, and thanks to the speakers today. Let's give a round of applause. Thank you.